In this third video, we're going to have a look at the rest of the transactions. In our last one, we got up to where we sold our 20 bags of jelly beans by cash, and we were just having a look at the effect it had on the profit and loss statement. I've just changed my profit and loss statement to include January on profit and loss. You can see that last transaction we got $400, and we can see our cost of goods sold, which was from our first entry on January 1. But what has that got to do with the effect on our balance sheet? If we have a look at our balance sheet, we can see that we've got $400 coming in, and we've got $600 worth of property, plant and equipment, which was when our owner introduced $600 worth of shelving. We can see that we owe $500, which was when we purchased the jelly beans from a company called Jellyman Limited. And we can see that our capital is $600, and we also are running a loss of -$100. So our total equity in our business is $500. So let's go in and look at our next set of transactions. Paid rates by $400 by cheque. If we have a look at paid rates on January 2, that will be coming into our payable worksheet. So going into payable worksheet, and we're going to change our date to January 2. Now, because we paid by cheque, we're going to assume that to be cash payment. We're going to type in this cash. The amount that we paid was $400. But GST not applicable, just for these questions. And we've got rates. Paid $400, so paid from, it's a cash payment. We'll say paid rates by cheque. Okay, we've got that there, that's fine. We'll click on making sure our date's correct. It's a cash payment, not an invoice. Paid cash, amount $400, GST not applicable, and its rates. We've got to enter in. It goes now in there. We can see the effect straight away by going back out and having a look at our profit and loss. We go to the profit and loss because rates is an expense. Just change my dates. We can now see that we've got our rates coming in there as an expense. What that has done is now made our loss even bigger because we're spending more than we're actually receiving, and that's not a good idea for a business. So coming back out to the main, let's look at our next transaction. Where we've got Mr. Jellybean or Jellyman withdrew $400 cash from personal use. It's the owner, so it's either capital or drawings. Because they withdrew, it must be drawings, and they're withdrawing cash. Okay, so we can have a look at that one there. So it's the January 3. It's a payable worksheet. Let's go to the payable worksheet. It's January 3. It's a cash payment. The owner is taken out, and that is Mr. Jellyman. We withdrew $400 cash, no GST, and it was for drawings. The account code. Okay, now we might come up with a bit of an error here. I may not have. I'm just going to look into the question to see if I've actually set up a drawings account. No, I haven't. So I need to create that account. So click on new account. It's drawings. Drawings. So it's an equity account, and then I click on save. Right, that's been saved, so I'll go back in here. It still may not. I'm just going to refresh this page. and I click, no, I've lost that, so I've got to go back to the cash payment, writing cash, right, I change the date, okay, to January 3, that was $400, GST, not applicable, drawings, everything pops up, and I can say owner, withdrew, cash, person, yes, unsaved transaction. Now we have a look at the balance sheet of the loss. You see some big differences here, there. We're still making a net loss of $500. Have a look at the balance sheet. See that this is now changed as well.